All right, so the markets finished the week on a very high note, very strong move to the upside, but it was pretty much a high note in only really one area of the market. I'm going to break that down, what area of the market that was. I think it's pretty obvious what area that was, but I'm going to show you. You'll see a huge disparity in just this week's returns simply because of that area of the market. And what the implications of that is that as strongly bullish as we think it is? Are we breaking out now because of the returns we've had, not just this week, but the last 2 weeks combined? Is the catalyst driving this bullishness over the past couple of weeks? But we'll discuss what that was, and is that going to be persistent enough to maintain a new bullish trend like we've seen in the past? Have we seen other moves like this within a correction? And I'll show you some examples of that as recently as the 2022 correction. So we'll take a look at some analogs for this type of move and see what to expect there. And then break down our trade idea of the day, a stock that has been a lot deeper correction than the market has been and has shown some signs of life. So we'll talk about how to trade it. So let's go ahead and get started. Today is Friday, November the 10th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here with this thumbs up icon. Click on that. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to our followers on those platforms. It's really helpful for us. That's why we always ask. Our goal is to get to 100 likes on Twitter, on X. I've been in the 70s for multiple weeks now, so let's see if we can't get that up to triple digits here again with this one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the nice rally we had way more than offset Thursday's decline, as we ended up closing well above the highs. I mean, even the highs over here from this mid-October rally that we had. Strong move higher. We'll see if that's the same across all the indexes, but for the S&P and the NASDAQ especially, as you'll see here in a minute, the momentum line spiking up from extreme lows to extreme highs. So we are near extreme lows below the 7th percentile, all the way up to the 96th percentile just in one day. It goes to show just how big of a move that was. The near-term line jumped up. Obviously, it takes more than just one day to make it go up significantly. So it will continue, barring a big drop on Monday, which, again, Mondays we don't drop. So until we start dropping, until we see more declines, you kind of have to bet on the markets just always being bullish on Mondays, considering the huge streak it's on, especially the NASDAQ. The NASDAQ, remember, never did get that one Monday to the downside. I think it was one of these over here. That the markets were down somewhere over here. I was on vacation, no less. Oh, it's right here. This was the one Monday the S&P was down in the past, however many Mondays it's been, 18 or so. So again, you would expect that the NASDAQ, remember, wasn't down that day. So you got to expect that we'll be rallying until we don't. Even during corrections, we rally on Mondays. So you expect on Monday that we will rally again. So you would think the near-term line will at least get, if not above the 80th percentile, into bullish territory, barring a dramatic decline. We are more than 2.5%. We were kind of capped just below 2.5%. We made a run. We were down to less than 1.5%, and then now we're almost at 3% above the moving average. So a significant change in sentiment there from one day to the next on the S&P to close out the week really, really strongly. From a weekly standpoint, you can see, again, after we got the bull tag, we've now closed back up above the high point of that week. So it's got the potential here of nullifying that bull tag. Again, we saw something similar over here. We never did close above the high of the bull tag, but we did bounce back up here in March and got, with a good 2-week rally, back up to the 30-week. In fact, got above it. And it got a green line. Here we got dark green shading a green line because we didn't drop as far. And the short-term sentiment over there got up to strong, both got to extreme highs, 98th percentile on the momentum line, 99th on the near-term line. Here you're near the 90th on the momentum and 93rd on the near term. So good, strong short-term sentiment move up. And you can see the intermediate line still, like it was over here, still below market sentiment. It's still below market sentiment now. And market sentiment is not even as high as it was then. It was really hard to get above it then. It was hard to get, I mean, that was a strong move in August. And we still couldn't get above market sentiment. So we're still not above it here. So we need to kind of get another week or two to get that intermediate line back above, into bullish territory, back above market sentiment, and maintaining this bullish trend that we've been on. So that's the S&P. Let's look at the Russell 2000. So this is a different picture. The Russell 2000 is back to dark pink shading in a red line. We did rally, but we didn't come close to rallying above any of these highs. We didn't even come close to getting above Thursday's high point on the Russell. The intermediate line is back into the lower half of the chart. Short-term sentiment's not extreme at all. It's up a little bit. It's out of the reversal zone, but it's not out of bearish territory, either one of them. So again, it kind of goes to show the distinct difference we have in the mega cap names, which is essentially the NASDAQ 100. The NASDAQ 100 is pretty much about 50%, close to 50. It's like 45%, the Magnificent Seven. And then now it's like 51% when you add in Broadcom and Adobe and Netflix up there too. So the NASDAQ is the big driver of this bullishness, the Magnificent Seven. I mean, we're pretty much above the August peaks in the NASDAQ 100. Very strong move higher. And then you can see here as well on a weekly basis, very strong short-term sentiment. The intermediate line never did get below market sentiment on the NASDAQ. We got the bull tag. We bounced up immediately. Very, very bull. And again, close above a lot of weeks highs here. A very strong move to the upside. But then you look at the Russell on the weekly chart, and we're not. In fact, we were down on the week. On the Russell 2000, we were down. And I tweeted this out. Here we go, right here. And you can see for the week, look how low the NASDAQ was up almost 3%. The Russell 2000 was down as much as the NASDAQ was up, and that was off of the lows. It was down more than 4% in the morning here for the week. And what's interesting is the correlation between real estate and the Qs has been really strong lately, but not this past week. And then you have commodities down here too. So your typical risk-on trades, all of your typical risk-on trades were all down. Then you had bonds and you had dollar up, and the Qs. So not really your typical risk on trade. And when you look at it from a sector standpoint, you can see, how just, we had basically one sector drive most of the gains this week, right? Over 4% gain on XLK when the S&P was up 1%. And then energy, utilities, real estate, materials, both of these dollar sensitive areas. So that, again, that's, the strong dollar, weak dollar sensitive, sector move, you would expect a stronger dollar where you would not expect the market to be so strong. And again, we can see why. We have one outlier to the upside. And that's not even all. I mean, XLY and XLC kind of lagged the market. So that wasn't even necessarily like Meta and Google, though they had pretty decent moves. But it's pretty much Apple, Microsoft, and NVIDIA. Those are the three, along with Broadcom and Adobe, that kind of fit that too. But they were the ones that had the strong rallies. NVIDIA, especially today. If you look at the sector, the market watch here, and look at the biggest companies by market cap in the S&P 500, and there's NVIDIA now over the $1 trillion mark. Right, it's now the fifth company, because 1.4 here, which is almost as big as Amazon. Alphabet's almost as big as Amazon. But now you have a fourth to join the crowd, right? You had two in the 2 million, almost at 3 trillion, 2 trillion, almost at 3 trillion. And now you have a fifth company in the $1 trillion dollar level. And you can see Meta and Broadcom really starting to work its way up pretty quickly to start joining a lot of these other tech names up to the upside. Meta's up there and Alphabet. But look at the gains, like, the Apple, Microsoft, and NVIDIA are your biggest movers on the day today. And you had some moves from Tesla and Amazon and Meta, but I mean, these are the bigger ones that have been for most of this week. And you see that, and you see why, like the Russell 2000 is still in bearish mode, right? Even as bullish as we've been, it's not even close to getting above these highs from earlier this year, like the NASDAQ is, right? The NASDAQ is above, is pretty much at its late August highs and close to those mid-July highs, but the Russell 2000 is not close to its mid-August highs, nor its late July highs. Not even close to it. And dark pink shading and a red line, and the near-term line's not in bullish territory, and the momentum line's already faltered without getting too high. And so you wonder just how bullish we're going to be able to maintain ourselves if that's kind of what a much more broader swath of the markets that aren't influenced at all by the Magnificent Seven are doing right now. So that's how the market outlook looks. If you look at the weekly chart here, you can see again very good bullish. I mean, the biggest bullish candle we've had in a long time. You have to go all the way back to over here when we were coming off of the correction lows. So very strong bullish candle, and we're trading, like, we'll start off with a pretty good bullish candle next week too. Whether it'll be as big, we'll see, because in 1 week we've already had the biggest candle. But that's okay. This was a big candle that started off a good move, a trend to the upside. So we'll see if that ends up being the case here. A lot of these other bullish candles, like this one in March, led to one more week. It was kind of flat. You can see the week of March 28th. If you look at the regular candle, March 28th here, you can see it wasn't that it wasn't that big of a candle. So after you had a strong move here, very similar to this move, right? So it's almost exactly the same. You had a big candle there on the 14th. If you look at big candle on the 14th, smaller bullish candle on the 21st, and then a doji on the 28th. Well, look at the Hakinyashi candles for that same time frame. That big candle on the 14th was a transition candle. A smaller bullish candle was a pretty decently sized bullish candle, Hakinyashi, and then the doji also got a pretty decently high. Well, here we are with our strong bullish candle 2 weeks ago. Last week was a smaller week to the upside, a decent bullish candle, but not as big, right? Very similar. And then now, are we going to get these kind of weeks over the next few weeks? That's the kind of rally I'm expecting us to see again after the first wave of the correction, a rebound. Well, here's our first wave of the correction to get below the 30-week moving average. We got below it, and now, is this one going to fail? Very similar to the March. That's my expectations, assuming that yields start to move back higher again, which is what I'm actually expecting will move back higher. Remember, the Russell 2000, different story, right? Let's go back to the Hakinyashi candle. We got the transition candle. We pretty much got another transition candle because we did get a bigger body, but still have an upper and a lower shadow here. And next week's candle is going to open up at 1714, and right now we're trading at 1705. So we're already back to a small bearish candle next week. So you go back to that same March time frame. That's what it looked like here, right? That March 14th big candle, smaller bullish candle on the 21st, and then really nothing on the 28th. And so again, the Russell kind of confirmed that was way too bullish on the S&P, mainly because of the NASDAQ 100 was so bullish there that we're probably going to have a similar situation here, where the Russell 2000 leads the weakness to the downside, like it led the weakness to the downside after that fake out pattern over there in November, right before Thanksgiving. Looking at the Hull actually had a pretty significant move on the S&P. Again, you can see we're right up against the 200-day Hull, so very important level here. The MACD, we're actually above it. The actual price is above it. The Hakinyashi is not above it yet, but you can see the actual price is barely above it, and the size of the bullish candles have really come down. If you look at the weekly version, we're flirting with the 200-week Hull. We did get slightly below it 2 weeks ago. We bounced back up. We're above the moving average. We got a strong candle. We flipped the parabolic SAR. We're not green yet on that Hull, and you can see over here we actually did get green, though we were below the 200-day Hull in March of 2022. If you look at IWM, it's a different story. We did get below the 200-week Hull. We did not get back above it here, even on a regular basis. We're down 3% below it still. Again, very similar. And then you can see the daily version. We've already reversed on the daily chart, and and looking more bearish than we are bullish. So you see how things aren't necessarily looking the high. I mean, it's great 3 green arrows, and it has been now for 6 days. Great, 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 not so good, right? And we only had it for a few days in the Russell 2000. You look at, and that's the daily version. If you look at the weekly version, you remember we don't have 3 green arrows yet because the MACD hasn't turned green, but you're that close. Look at the weekly version here. Let's actually go to the 3 years so you can see a little bit better. You can see a little bit better there. So not quite there yet. And we don't have, but we had 1 week of 3 red arrows and we bounced. We had 1 week of 3 red arrows there and we bounced. You look at over here, we had more weeks of 3 red arrows, and now we only have the 2 greens. So the Dow's looking worse, and then of course your Russell has been 3 reds this entire time. So and no greens at all, not even on the MACD. So you see a disparity, and it's mainly again coming from one source. Looking at the 2 line versions of this, we're above the 50-day moving average. The Qs are way above the 50-day and 200-day, and breaking above this 78% Fibonacci retracement of the correction, breaking above the point of control, looking very good. The diamonds not looking as good, but at least above the 50-day and the 200-day again. That's a good sign. We are a lot further below the 200-day. We're not above the 50-day or the 200-day on the Russell. We got that bear tag above the 30. We failed. We're back below the 8 and the 17, and the MACD is back to being negative. We're below the point of control. We're still below the value area for the past year, and you can see we're actually in bear market territory because we're well below the 200-week moving average and staying below that 17-week. See a vast difference between the Qs, which is well above the 200-week, and bouncing back up above the value area and the point of control and all of that. MACD turning up, not back above its moving average yet, but turning up there. And at least at the beginning of the week next week will be. The DMI is not very positive. I mean, you're still above 20 on the negative indicator. You're still actually below 30 on the positive. That's not a good sign. The Qs is slightly better. That's about more like we want to see. IWM, of course, is not better at all. So significant difference there in the oscillators. Looking at the RSI and the CCI, you're a little bit above 60. You did not get above 150 on the S&P. The NASDAQ, not X, the NASDAQ also got well above 60, 64, but did not get above 150. And we are, so you got close, 144, and you got a divergence pattern here forming. And of course, your Russell 2000 is even worse, right? You're below 50, so you're back to bearish levels, and if you didn't come close to 150, and you're already almost below 0. Remember, the weekly charts, what's really important to determine whether or not we're going to turn bullish here. We're above 0. The question, and we'll start the week next week with a pretty good move on whether we finish above positive 100 next week will be very important for a trend change. See, we did get above positive 100 on the NASDAQ. That cannot be a fake out, right? We've got to stay above positive 100 for at least another couple of weeks to really confirm the change. After being below minus 100, of course, the Russell 2000 is not even above it's barely above minus 100. So you see like a very significant distinction here. The Ichimoku cloud, we are at the top of the cloud on the S&P. We're well above the cloud on the Qs. IWM, we're not even close to the cloud. That's on the weekly chart. The daily chart, we're below the cloud on the weekly chart. We're still kind of flirting with no trend at all on the weekly on the SPY, and you can see we ended the bullish trend a couple of weeks ago. So this is kind of what could be the beginning of a new one. We'll see if it ends up being something like this, though. You can see it's kind of rare to have at least an intermediate trend strength going, and this was actually a mature trend strength. It wasn't as mature as some others, but it did get above 80. It did get above 5, and so once it ends, it's hard to restart a new one again, as you can see here, without at least some kind of correction there. You can see a correction there. That's usually what kind of like 2014 may be the one period where it ended and we just restarted a brand new one. Right there. Remember, we had QE going into most of 2014 until the fall, right there. And then you also had, of course, 0% interest rates. You didn't start even raising it once until the end of 2015. So much different monetary environment from an accommodation standpoint now than we had then. And even 2011 was more of a correction, or 2010, excuse me, more of a correction in between. And 2011 had a correction in between. And, again, another sign of correction, the fact that you broke zero, and you're probably going to have some weeks here of correction before, if we start a new one, new move to the upside. Looking at the Bollinger Bands and the Keltner channels, you can see the band width again is a smidgen in the upper quartile. It's got to be a lot closer. It's got to be in the 90s. I mean, even the Qs are not in the 90s. And see, this one got up here too into the 80s, but couldn't get close to the upper band. It did break out above the Keltner channel. The Qs did break out above the Keltner channel, so that's unique. SPY got a smidgen above it. Of course, IWM is different, right? We're not even in the upper half of the bandwidth. The bandwidth is high, and the bands themselves are still, we're nowhere near. We didn't get above the upper Keltner. We're not even close to the upper Keltner channel now. So in my opinion, I think the market's going to end up behaving more like IWM, and this is going to end up being kind of a fake out type move like we've seen already, multiple instances. More so than the last one, but more like the August one where we were a lot more bullish there and we faltered, and more like, again, the end of May of last year and that March timeframe of last year, I think, is very similar analogs to what we're seeing here right now. Looking at the intraday move, of course, the one other good sign is we got a new 4-week high point, right? So we've had now 2 days, which, again, we've had a couple one touches, and one touches are very bearish. So we got a 2 touch. So that's good. The Qs have had more than 2 touch, right? We've had a few over the course of the week. IWM, of course, is nowhere near its 4-week high point and won't get it. The 4-week high is going to be there now for a while, so we have to have a really significant move to get to a new 4-week high, and I expect we'll actually have more of a 4-week low point. Remember about the SPY. Remember, IWM has filled that gap in. SPY has not. That is a common gap, so it is more likely to get filled in than not. Even this morning's gap, Friday morning's gap, we didn't fill it in all the way. So we're more likely to fill that in than not, sooner rather than later. So again, that puts in the context this rally that we got. A higher high and a higher low. We closed above the high. We closed above last week's high. But they're still very top heavy from a volume standpoint, and there's still that common gap that now, if we even get into, we're going to be below the point of control and into an area of very, very low volume. So again, like we saw with IWM, once we got into that gap, then things got really bearish for IWM. And so, in fact, we started to fill in Thursday's gap from there. And again, I expect if we're doing that in SPY, then things are going to be a lot more bearish than what we really, really want to see right now. And a lot of that has to do, and that's one of the reasons why the VIX is so extremely bearish, right? We're down to almost the 85th percentile. Keep in mind that we are still in correction mode on the S&P, and the VIX is already well below 15, like almost below 14. The VIX to VIX3M is way down here, well below 90%, and the VVIX is well below 100. It had gotten below 85. Down to like 82 and change, and it's still around 85 as the correlation is getting a little bit weaker there. The VVIX is starting to ramp up. In fact, this week, when you look at what happened here, remember we had such a big drop last week in the VIX, and this week is kind of maintaining that. But the VVIX, you see, was actually up this week. The VVIX had a huge drop of 2 weeks. When you look at it on a rate of change, one of the bigger 2-week drops in the VVIX, which again is just kind of shows just how complacent the market is. As that sets up here, let's go to a weekly, you see how big that drop is. Usually that sets up a move to the upside on the VVIX over 2 weeks. And again, that generally sets up a rally in volatility, right? When you get these big 2-week drops, you tend to get some rallies over a few weeks. As we saw at the end of 21, and as we saw here with the coming off of the March, the banking crisis, and what we saw now, No change in policies, right? The biggest reason why we've had this 2-week drop is because yields have dropped, and the question whether that will be sustained is the story of the day, right? Speaking of yields, you can see the decline the decline that they've had, down to the 50-day moving average, holding up, right? Trying to get below it, couldn't quite get below that lower shadow from the 3rd, which would have been last Friday, and then holding up right above that kind of 4.6% level here for most of this week, as the MACD histogram is turning up and the stochastics is turning up almost above its moving average. So obviously it needs to do more than just a few days to the upside. It needs to get above like the 17-day at least, and the MACD get back above its moving average. But you can see, again, it's been a good decline. Obviously the intermediate line falling more than it had during these other bull tags that it got. So it got a bull tag and it faltered. We did get the intermediate line down. You can see the near-term line's already back up and moving higher again. And again, that's typically been bearish for equities if we get a move back up to the upside. As again, this intermediate run, we dipped below on the 3rd, the 23% retracement, and we finished this week back above the 23% retracement of that rally, and of course did not get below the 38% retracement. And I don't think it will. A lot of market scholars, a lot of our discussion here was, will it get to 4.25%? So basically a good on, full on correction type mode on yields, or will it hit the 5% first? I expect it'll actually hit both eventually, but which one will it hit first? And I expect we'll hit 5% first. In which, again, the whole reason why we've had such a strong rally is because of the strong decline in the a strong decline in yields, and for that matter, a little bit of a decline in the dollar too. And the dollar hit Fibonacci retracement, long-term Fibonacci retracement back on would have been, based off of this low point off 2021 low. We hit that 38% retracement that we were trying to get above. We do have dark pink shading and a red line. We're back to light green shading as the intermediate line. The near-term line crossed above the intermediate line with it being between 20 and 80, and it's turning back up again. Of course, if you look at Fibonacci retracement off of the most recent intermediate level, we're back above the 23% retracement. We didn't even get to the 38% retracement. So very shallow pullback that kind of culminated in Friday's decline. And then, a little bit of a fake out pattern as we just rallied back up the rest of this week. And you can see what it looks like on a weekly basis. Again, the weekly chart, the intermediate line still in the reversal zone, and the near-term line's not even that bearish, and momentum line's already starting to turn up there. So that's been the reason. This decline in the dollar and decline in yields, and really also a decline in commodities, though it seems like the relationship, which has been a negative correlation between commodities and the, let's just go to here. Let's zoom in on this. That COVID drop really throws off the scale. But we've been declining already while stocks have been declining. So there's been kind of that correlation there. Of course, last 2 weeks we declined even more, and we got below that 30-week moving average. And here's what the daily market forecast looks like. We did get below the 2% retracement into some clusters, and a little bit of a morning star candlestick pattern that we developed here. Whether that turned into something more, of course, means that the near-term line's got to get into the reversal zone, right? It's got to get up here into the reversal zone so that it rallies, so we can get the near-term line out from these cluster lows. But much more bigger decline, but we had already been declining earlier on commodities before this last week, and you can see even this week we've had even more of a decline in commodities, even though the S&P and the Nasdaq are so bullish. So it's been going down with stocks, and it's been going down without stocks, and so that's a little bit different story, not in my opinion as important, though. From an inflation expectation standpoint, if we were to reverse this decline we've had this week and getting back above 81, then there goes the inflation expectations. Though if you look at inflation expectations just in general to see, okay, are they really declining here? If you go to the Analyze tab and go to Economic Data, so that's the break-even rate. Let's go to the inflation expectations chart here. which is there we go, the inflation expectation rate. And we'll just go to like a 5-year chart. Well, let's go to a 1-year chart so we can zoom in. We did have a pretty significant decline this week, right? Not last week. Going into the end of last week, we were still pretty high. But this week, we dropped down to where we were essentially at the beginning of September. And if you look at like, okay, beginning of September, we had this decline in equity. And we're actually lower now than we were then with this little bit of a fake out move. So, that sparked, inflation expectations jump back up again, and so did yields. And we'll see if that ends up being the case here, if we end up jumping back up again like we did there. So really important here the next couple of weeks to see, kind of what happens from an inflation expectation standpoint, and of course what this Moody's downgrade does to yields, because I expect that this Moody's downgrade will be a catalyst for yields to make a run back towards 5%, and inflation expectations start to ramp up higher again. Of course, you saw the sector moves. Let's look at the sector grid, the 12 grid for all the major sectors, and you can see again we've got dark green shading and green line. Look at technology, just killing it. It's a huge outlier in a 3-month return, up 7%. The only other positive return here is communication services, which is only up 2%, and it's kind of got dark green shading. Nothing else. Look at energy is on a decline. Light pink shading with healthcare, utilities, and real estate. Industrials and staples are kind of trying to turn up. Materials is light pink shading. A little bit of a positive run on financials, but still down less than 3% for the 3 months. So dramatic. You can see we have pretty much one driver of this move, and again, how lasting will that driver be? Because you look at that rate of change for XLK over the last, would be 11 days that we've been this bullish. So that's the 26th day. If you look at the last 11 days, we're up 12% over the last over 12% over the last 11 days. Again, you can see that's higher than any other time in the past year. You have to go back out to, again, going right here, 12%. You can see you have to go all the way back out to that March time frame where we were up 15%. And then eventually we had an 11-day decline of 9%. As you can see, we always, after you get an 11-day peak, you end up with an 11-day decline of a certain amount. And then, very similar how we didn't have that big of a drop going into that rally. We didn't have that big of a drop going into this one either. So I'm a little concerned that we'll end up with this kind of a decline, very similar to what we saw over here, where you had the first wave of the correction. And, remember Jim Cramer famously said that the bear, first of all, he called that a bear market. Second of all, he said the bear market was done. It was either the 28th or the 29th. But very famously almost called the top, and then we got the second wave of the correction, and then eventually the third wave down to the lows. But there's your first wave, not as dramatic as the first one in 2022. There's the move that potentially ends the correction. That ends up being a little bit of a fake out, potentially a fake out, and we'll see if that ends up producing an 11-day decline of 9% or more. And that's, I don't know if it'll get to 9, but I'm expecting something along the lines of like 5+% to the downside over, and whether it's the next 11 days or sometime within the next 15 to 20 days, I'm expecting an 11-day decline of that much or more. As you can see, is typically what we always get after these kinds of peaks. All right, that brings us to our trade idea of the day, and the trade's on Delta Airlines. You can see Delta, it's got a bear tag here recently. It looks again, similar to Russell 2000, as it's been bearish here for quite a while. Obviously, a lot of clusters on this intermediate decline. So it's been heavily oversold, very big. In fact, when you look at the zigzag on this chart, and let's change it to a 10% decline. The S&P did get a 10% decline here on that, but let's look at Delta. We're up 7% right now. But look at Delta here, 37% decline. After a 54% rally, a 37% decline here. So significant drop on this. And you can kind of see how the declines appear to have halted. We got we got the transition candle last week, a little bullish candle. PPO still falling, so nothing too majorly bullish here. Your at the point of control, you're off of the lows. The MACD is off of these extreme lows. Stochastics in the upper half of the chart. Looking at some of these other indicators like the DMI, you can see they're both below 25 now after such a strong bearish move. Look at the RSI and the CCI after such a strong run there too. You can see it back, not so bearish, more into bullish territory. And then of course looking at your Ichimoku cloud, we are still well below the cloud, but we don't have a bearish trend anymore. And then your Bollinger Bands and your Keltner channel, you are in the middle of the chart, kind of in the upper half of the chart, and you're really lost that momentum. And the bands are a lot closer to being inside the Keltner's channel for the longest time. So it's gotten a lot more neutral. And so what I wanted to do here was take a look at selling at the lower delta, so give myself a little bit more room to the downside, and selling a little bit closer to the upside. So it gives me a condor. It looks like this. And there's where my break evens are. So I have these old highs up here, and I have the low point that we've already established. I think that's probably going to be a low point here for a while. We might retest it a little bit, but I don't think too major. I think we've established the low for a while, and then you can see I have some upside built in for any kind of rally we may get, but more than likely probably staying near this point of control. And going for that full maximum gain, not having to worry about earnings until after the December expiration date. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all next time.